Street analysts are raising the target prices on the market. Look at this guy, 3,600, 3,500. The lowest one is 3,440. I mean, just a few months ago, these guys were at like 3,050. I mean, 3,080. So while these guys are actually increasing unanimously the price targets on S&P 500, they're not really acting as bulls. They're acting as a herd of sheep. And for the purpose of this video, we're going to use this as one of the signs why the market is actually about to drop 10%. So take a closer look at these guys, which are telling you on TV right now. We'll just call them, for the fun of this video, the usual suspects. And when the usual suspects raise the price targets on the market, expect a short-term drop. In this video, we're going to uncover the detail of what the VIX is about to do historically, why and how to trade the coronavirus. Guys, we're going to take a look at a bunch of charts, so grab a pen and paper. Let's roll and do this.
You're goddamn right.
Here's the number one reason to actually be short the market right now. 13 markets move forward, point to a sizable drop in the market in the next 72 to 96 hours. Very deadly sequence to the bulls. 11-11, 7-5, 11-6, 4-2. It highly resembles the last two occasions where we have accurately predicted the market dropping like a rock. And I'm going to show you specifically the charts. But take a very close look at this sequence because it points to some really substantial drops near term. So here it is. 13 markets move forward, guys. Points to a break in the bull trend short term, specifically in the week of January 27th through 21st. We got a deadly situation for the bulls right here. We're actually noticing a shift. If you focus right here in this column, which represents all Thursdays, we had a pretty easy trend. 777, pretty much identical move. All of a sudden that changes. You will also notice right here that while the VIX was in the red pretty much every Thursday, all of a sudden we got VIX in the green, which coincides with the third day higher in the VIX. Now, it also coincides with a very bearish market move sequence, 11-6-4-2. Guys, last time we witnessed something close to this, the markets unfolded in one instance literally by 800,000 points within a couple of days. In other instances, market produced drops of literally a few thousand points within a couple of weeks. Guys, so this is serious. If I was to call this video, this is like the red alert. So it doesn't matter whether you're a bull. If you're a bull, you should get out of the market and short the hell out of it. If you are a bear, then take this as probably one of the biggest opportunities we've had in the last 12 months. Since basically last December, the prior year, December 2018, when we had this huge drop. This could be repeated right now. And I'm going to present a bunch of evidence. So focus right here, guys. VIX is a huge part of the 13 markets move formula. And this VIX move actually coincides with another move in the history of the markets, which results in a 1,000-point drop in Dow Jones Industrial Average in just a matter of days. So VIX solid uptrend, as you can see now, for 4 days in a row after it's been trapped in the sideways trading top tunnel in the sideways range. So here's what we're actually going to take a closer look right now. So we got the 13 markets move formula pointing to a drop. We've got VIX pointing to a huge breakout in the VIX, which would result in the market drop. But right now, if you're a trader, if you're a day trader, swing trader, this is one crucial thing you need to understand about this coronavirus. And it's not about how does it act, how quickly, how many deaths and all that stuff. That's not important. And I'm going to reveal to you why. What is important is to look at how historically market reacted. See, so many people focus on the news and what's being said, and they're trying to make their own judgment about what's going on. The only truth in the markets is in the market reaction. It could take the same information and react to it differently. In other words, a company could announce great earnings and the stock could fall. It could announce bad earnings and the stock could go higher. It happens all the time. So the question is, how can we analyze this coronavirus data that we have historically on the charts in order to be prepared as a trader to trade the short-term moves in the market just here in the next 2 weeks to 2 months? So important historic facts about the SARS virus that every trader must know is the reaction of the market in relation to the historic timeline. So the timeline of the first virus we're going to take a quick look at is the SARS virus, which first was initially discovered in November 2002. So the timeline on this, guys, is going to be November 2002 through July 2003, and we're going to take a very close look at the charts, and we're going to try to make some sense out of this. Okay, so November 2002, disease actually appears in China. It's important that it appears in China opposed to any other place. Okay, now what we actually get as some substantial headlines from the World Health Organization doesn't really recognize it officially as a serious threat until February 2003. So as you can see, the first point in the timeline here to understand is until the problem actually is being acknowledged as a serious issue, the market is already moving. And I'm going to show you exactly where it's moving, but nobody's taking it quite seriously. Okay, so there is a delay on this timeline. Okay, so it doesn't get officially recognized as SARS until January, February 2003. Nobody takes it serious for a couple of months. And here's what's happening on the charts. And also, very important to understand this fact. Okay, on January 23rd, this is the headline was surfaced. Now we're talking about this January 23rd, just a couple of days ago, January 23rd, 2020. So Wuhan coronavirus is not yet a public health emergency of international concern. WHO stands for World Health Organization. Okay, so let's see why is this even important right now. Here's the timeline going back to 2003. The virus in 2000 was detected in 2002, November 2002. Okay, the headlines didn't start surfacing until January. Okay, now only on March the 12th, 2 months later, World Health Organization actually issues a global alert for severe form of this virus. Okay, now interestingly, that last few headlines we've gotten, again pointing to this January 23rd, World Health Organization said the coronavirus is not a global threat yet. Now, it does not mean that it won't change its stance in the near future, but I'm pointing this timeline for you guys so you understand that there is a delay, okay? And by the time agencies like World Health Organization actually realize that this is a threat, the market reaction has already been played out. So let's take a closer look at an actual chart. So this is when the virus was detected. Okay, as you can see, that's November. This represents November. The market peaks short term on this chart. Then it starts dropping. Okay, this is where the headlines actually start surfacing saying, hey, we may have something serious here. Notice the time frame on this. March 12th is right here. So between the time World Health Organization actually officially recognizes this as a serious global threat, okay, almost 2 months go by. In the meantime, the market is down 15.9% from here to here. Now, you may be thinking, okay, well, hold on. Where are we on the timeline right now? I need to know this in order to trade the markets this week. We are right here, guys. We are just at this early beginning of this potential huge drop. Now, we're actually going to show you specifically the levels on the Dow Jones. And the reason I'm going to use the Dow Jones, because all the headlines you're going to be hearing in the news over the next week or two, they're going to be referencing this big drops in Dow Jones points. So to make it easy and to make the comparisons easier, okay, we're going to be using the Dow Jones chart. But if you want to actually follow this on your own and plug the charts of NASDAQ, if you want to plug in the charts of S&P 500, they're going to be almost identical, okay? If you just want to take the measure in percentages and apply it to the other two indexes, then you're basically going to get the same type of results. So basically the market drops from 8,800 right here all the way to 7,400. That represents a drop of about 15%. Now, as you can see, this candle right here coincides actually with the date. It coincides with March 12th. The market makes this huge last day drop exactly on the day when what happens? Exactly on the day when World Health Organization issues the global alert. So hold on. This makes no sense. Leonardo is saying on the day they actually announce how bad shit really has gotten, the market starts going higher? Yes, that's exactly what I'm saying. It's important to know that because as a trader, you know, not only you want to play the short-term move lower, but you actually want to be prepared that, hey, there's a big move higher that's actually going to take place. Also, don't expect the market to fall just in one straight line. So, many videos we've been utilizing a simple strategy of shorting the bounces, guys. If you don't know what that is, you know, click the link below this video in the description, get more information about it. But basically, as you can see, initially you get a huge drop, followed by sideways action, follow through on another drop, then bounce. So anytime bounces happen in circumstances like this, it's a good idea to short them because you see the next leg down is being created. So for those of you that did not take any action on the video that was actually publicly posted on the channel on Friday, we specifically identified a move to. We specifically identified the time frame on how to trade it. But yet I've talked to some traders. They were like, man, Leonardo, I got in, I made a little bit of money, and I thought the market was not going to go lower anymore. I started buying the dip, and then I lost the money. Guys, let's be 100% clear, okay? This is not the time to buy the fucking dip, okay? You do not want to buy the dip this week. That's coming up. That's starting tomorrow. I'm recording this actually on the Sunday, the 26th of January. Okay, this is not the time to buy the dip. Do not buy the damn dip over the next couple of weeks. Because as history points out, okay, this stuff, okay, it's not a one-day drop, it's not a two-day drop. This stuff could be going based off the reaction of the market in the history. This stuff could be going for a couple of weeks. But yet again, the question, why, when World Health Organization officially recognizes this as something incredibly serious, why does the market start going higher? See, important to understand that the markets drop in conditions of uncertainty. When something is unclear, it's unclear how deadly and how crazy things can get out of control. And it's not even the fact about the virus, but how does the virus impact businesses? How does it impact travel? How does it impact various parts of the economy, which ultimately plays in the economic projections when we calculate the GDP. So when these analysts go out and they put certain valuations on the market, all of a sudden what they used to think a week ago when they were raising prices on the targets on the S&P 500, all of a sudden that's going to have to be readjusted and reevaluated because now we have this potential level of uncertainty. And using this historical data, guys, it points to the fact that the markets could drop by as much as 15%. Now I'm going to show you something. I'm going to show you some really cool charts in this video, guys. This is a really good video if you're trying to make sense of this market. So let me show you some other stuff right here. So we go through the timeline, and so basically we get to July 5th. World Health Organization announces that global SARS outbreak was contained. Now, what is happening between March 12th and July the 5th? Well, the market's basically at this point they price everything in. They price the worst case outcome. And so when they announce, hey, the stuff is really bad and serious, the market starts moving high. Now, notice this. Every time it bounces, it drops. It bounces, it drops, it bounces. So this is a ton of trading opportunities, guys. So by the time they actually announce that the virus is contained, there's like almost no reaction because everything has already been priced in. So this was the worst point, which comes within 60 days, okay, after the conditions that we currently have. Okay, then at some point the worst gets priced in. All of a sudden the unknown is no longer the unknown and the markets begin to rally. So expect this to materialize, guys, over the course of the next 60 days, which is going to create some unbelievable trading opportunities. Just as this is going to seem like everything is just going to keep crashing and crashing forever, okay, you're going to see that the bottom is going to be set and the market is going to start moving higher. So awesome stuff as far as trading opportunities. Same thing happens in Hong Kong, right? So this crazy professor from China goes to Hong Kong to a wedding. He's actually the virus carrier himself, and he ends up being admitted to the hospital in Hong Kong, and 70 people, the staff at the hospital gets sick, he dies, but before he dies he tells them, hey, I was actually working at a hospital in China and that's how I got the virus, but knowing the Chinese, we don't like to advertise how bad things really get. So all this stuff that they're talking about in the news right now, guys, when they're saying, hey, there's 40 deaths, there's 50, whatever, like, take that number with a grain of salt because chances are that number is not real. Chances are that the number of cases is much larger because Chinese, they don't necessarily like to share that kind of data. At some point, you know, there's going to be the aftermath, but take the numbers that are coming out right now daily, and indeed, they are much greater than what they appear to be. So same situation in Hong Kong, with an exception is where the market actually stops dropping here in the United States after 60 days. All right, the Hong Kong market drops 12% if we take the same time frame compared to the United States market. But this one bounces and then it continues, it gives us another leg lower. So if we calculate from this point to this point, it's actually a 16% drop. So very consistent, right? You got international markets dropping by pretty much identical amount, slightly different time frame, but literally we're talking just a couple of percentage points. But the idea is the same, right? This is not a one move lower forever type thing. You're going to see a history of bounces. You can see a history of lower gap downs right here. Okay, so all of this, guys, when you see this stuff, what do you want to do? Do you want to day trade? Do you want to swing trade? Okay, the market moves formula has been pointed out to a very effective strategy, how you want to keep the positions overnight. You want to swing trade this market because there's going to be a number of instances where you're going to wake up and the market's going to be down 500 points and you're going to be like, what the fuck just happened? I should have listened to Leonardo, okay? This is why I'm trying to break everything down in slow motion here in this video, guys, so you actually look at this historical data and then you actually take action to make a bunch of money. So here's the deal. By the time all's said and done, right, the markets just have a small pop. So what we can draw from what I've shown you guys so far is the market is going to move lower. Yes, they will buy the dip at a certain point. We can expect to move between 12 to 16% in worldwide markets. Now, the SARS mortality rate was around about 10%. Officially reported, after all said and done, about 9,000 cases. The number actually was probably bigger. We'll never know, guys, the real numbers, but to use, it was about 900 to 1,000 deaths altogether. Okay, MERS mortality rate, which is the virus that broke out in 2012. We're briefly going to take a look at that to build our case a little bit further here. So, in this particular case, we get about 400 deaths. Okay, but the mortality rate is substantially higher. If we take a look, we got about a 10% mortality rate with SARS virus. We got 34% with MERS virus. What is different here? Well, the source where the virus was originated, the country, okay, Saudi Arabia is not as heavily populated as China, clearly. So, therefore, it was a little bit easier to contain the virus. And for that reason, the number of cases was not as many, even though the mortality rate would be higher. So I guess what I'm trying to communicate to you here, guys, it's not the mortality rate, you would think, well, if more people are dying, the market should be dropping more. That's not the case. You got to look at the source, at where the virus has actually been originated. And in this case, okay, what we're noticing is this. One thing we do know based on the charts is this. It's not the mortality rate, but how fast the virus actually spreads initially that creates huge reactions in the market. It's the expectations of the unknown that freezes travel, businesses, and ultimately human mind.
It just came off out of the blue. It was off of everybody's radar screen. In February, we're all talking about what's going to be the impact on the Iraq war, on tourism, on oil prices, on the stock market. SARS hit. All of a sudden, we're not only seeing nobody on the airplanes, we're not only seeing nobody in our stores, but we're wondering what's going to happen to my child, what's going to happen to my family.
From spreading, please cover your nose and mouth when sneezing or coughing. Wash hands with liquid.
So the origin of the virus seems to have a direct correlation to the market reaction. So in case of the MERS in 2012, which was born in a much less populated area than China, market reaction was much more muted. Yes, we get a drop. Okay, the MERS virus was detected in September of 2012, and right about here, the market actually doesn't think it's a big deal at first. Then it starts dropping a little bit, pops, managed to actually create a pop, and then drop again, another pop. So if you would have shorted basically each one of those bounces, guys, you would have made a ton of money. Then you get a sharp drop by November. So here it is, 60-day timeline, 8.8% drop in roughly 60 days. That's what we get in the second major virus, in the last 20 years. Why did the market actually sell off double digits in both cases? And particularly, we really want to study the Chinese version where the virus actually originated in China, simply because of the fact that that's where this coronavirus, or the form of this coronavirus, was originated again. Okay, so the market doesn't sell off because of the virus itself, guys, but it really sells off because of the uncertainty of what will actually be the impact on the Chinese GDP. And at that point, they were estimating a drop in Chinese GDP anywhere from 0.5% to 2%. So that was huge, okay? Just to be able to think that all of a sudden Chinese GDP is going to drop 2%. Yeah, that will get some double-digit drops in the market, okay? And the second most important aspect, because Chinese economy now is much greater part of the global economy than it was in 2002, 2003. Therefore, it would have a greater impact on the global economy as well. Now, here's the important thing, okay? The current virus in 2020 is so far known to be born in Wuhan. Now, important thing about Wuhan, I don't know how many of you look at the Chinese map often, so I figured I'd insert a quick slide here for you guys. But Beijing is about a 2-hour flight. Another big city in China is Shanghai. That's about hour 55-minute flight. In terms of miles, I mean, that's about 300-400 miles. That's about 500 miles. So we're not talking about a huge travel distance. And these are some heavy populated area. Wuhan by itself is 11 million people, guys, just to give you an idea. Now, in the prior viruses, we've noticed in China, when they were developing, they live in these big apartment buildings. And there was an instance in 2003 when one person in one apartment building, literally over the course of 48 hours, got 200 people sick. Okay, so what we don't know is, how quickly this virus is really indeed spreading, because we don't know how real these Chinese numbers that we're seeing in the news, they can be 100% accurate. Okay, so considering the fact that China represents a greater part of the world economy now than it did in 2003, guys, the impact of current coronavirus on the GDP and business activity could be much greater. Okay, so exactly how low can we go, Leonardo? Just tell me the deal, man. How low can we go? All right, so if you use different percentage points, okay, we are right here. Okay, we're at 29K. So we're going to use a number on the Dow Jones of 29,000. Okay, here's different percentage points. If we drop 5%, we're going to be at 27,550. If we drop 10%, guys, we're going to be all the way down here in the 26,000 range. Okay, if we drop 12%, we're going to be all the way right here, 25,706. So we drop 15%, guys. We're in the 24,000 range in the Dow. Now, I know if you've been a bull lately, it's like, this is like unimaginable, right? This is like, what do you mean we're going to erase all the gains we've had from August, September, October, all the way till now? You're saying we're going to erase them like within a couple of weeks? Yes, guys. And I'm actually going to point to 2 other instances in the history where this has actually happened. And no, it wasn't 1929 or 1987. I'm talking about recent stuff that most of the traders has already seemed to have forgotten. So here's the shocking part. The shocking part is to understand why the drop could actually exceed the drop in 2003. Hold on, dude, you just showed me this right here, how it can be going to 24,836, and now you're telling me we could actually be dropping below that? Oh man, I'm definitely unsubscribing right now. This is just crazy, man. Okay, so here's the deal. Why could this actually happen? Well, the main reason is the pre-existing conditions, guys. The pre-existing conditions, when we put together some of these crazy earnings plays that generate you over 1,000% returns, guys, a part of the formula is to look at pre-existing market conditions. Well, if we use just to draw some basic analogies, okay, there's two things, okay, that are very different about the market conditions right now than we've had back in 2002, 2003. So the pre-existing market conditions did not favor a huge drop back in 2002, 2003. But conditions right now actually favor a huge drop. So here are the details, guys. If you take a look at Hong Kong, back in 2002, 2003, it was already like moving lower. When we were trading right here, right before the market in Hong Kong started dropping on the virus news, we're already 30% off the highs. And if we take a look at where some companies were trading, like take a look, this is just for the fun, okay? Amazon, if Amazon would have dropped 21 bucks, it wouldn't even be a penny stock, okay? Because at the time, Amazon was trading at 21 bucks, all right? BKNG would turn into a penny stock if it dropped like $7, $8, because then it would be trading at 46 cents, okay? So, guys, market conditions were totally different. So, in other words, BKNG went from, you know, like $62 all the way to $8. In other words, stocks were already trading closer to their lows of the prior 12 months. Okay, the market overall, if we take a look at the Dow Jones back in December 2002, January 2003, guys, it was at 2,300 points off the highest level over that running 12-month time frame. So we're not at 11,250. We're all the way down to like, you know, 85, 8,800 range right here. The markets were not at their all-time highs. So in other words, the market were already getting hit, you know, substantially over the last 12 months prior to the virus news coming out. The markets right now are trading at all-time highs, as you know, and we're observing this high probability of a loss of momentum pattern. Now, a loss of momentum pattern, the easiest way to explain it, think of Bitcoin in December 2017. It was trading at 20,000 and everybody was screaming it was going to go to $1 million. Okay, we actually predicted Bitcoin was going to drop within 12 months to 3,000 bucks, and we were 100% accurate in that. How do we do it? We utilize this loss of momentum pattern in combination with the 13 markets move formula. The video is still somewhere on this channel, one of the first few videos we've ever posted. So the fact that the market's trading at all-time highs brings one very recent time frame in the history of the markets, and exactly 2 years ago is when the time frame took place. Okay, and it highly resembles current market conditions of extreme bullishness and trading at the historic top. Now, January 29th, 2018 is what I specifically refer to you when I say this. So that's actually followed by the crash no one expected besides us. We actually predicted that drop utilizing our 13 markets move formula. So here's the deal, guys. This is where we were January 29th, 2018. The market dropped 3,400 points on the Dow within 2 weeks. We went from 26.6 all the way to 23.2. Now, most of the traders simply don't remember that. Maybe you're a new trader, so you don't even think that this is possible. Now, let's focus on what was actually taking place before this 3,400 point drop took place. Look at this. November, markets moving higher. December, markets moving higher. January, markets moving higher. Everybody's convinced the market will move higher forever at that point. And that is exactly how some analysts lose their jobs. This is exactly how some funds go out of business in a matter of 2 weeks, because they don't have a formula that tells them when markets could drop by 3,400 points in a matter of 2 weeks. So the conditions were insanely bullish, just like they are right now. The market was trading at the all-time high at the time, right here, almost closer to 27,000. That condition is met right now. Now, there's another condition that highly resembles that one. First, let's take a look at the Hong Kong. As you can see, down to a point. Actually, Hong Kong tops 1 day before Dow Jones tops. So in this case, Hong Kong was a leading indicator of a major reversal in the US market. Now, it's important to understand that on January 28, 29, 2018, there were absolutely no headlines of any sort of virus. But the reason the market was dropping, because all of a sudden the interest rates started shifting at a pace that was a bit higher than expected. In other words, the market all of a sudden got the fears of inflation. And that's what the fear of inflation created. It actually created a 4,500 point drop in 2 weeks in the markets in Hong Kong. Now, just to give you an idea, how did it impact certain stocks? In January 29th, BKNG was trading just under 2,000 bucks. It fell $280 all the way to almost touching 1,700 level within, yes, you guessed it right, within 2 weeks. Now, if you've been paying close attention to the channel, we did post a video last Monday when BKNG was trading at 2,054, 2,060 level. Since then, it dropped already 100 bucks. So congrats to you that took action in that trade. And actually, we've traded multiple times this past week, guys. So that was an awesome trade. Congrats. Okay. Now, with that said, other stocks were falling to the similar proportions, just like BKNG. So look at all the big names to actually unwind, especially the names that have been going higher and higher and higher without any particular catalyst, just on the pure bullishness of the market. Those stocks will take a hit. Look for the highly crowded stocks, because the first point I said when we started this video, I said, look, these are not bulls. They are a herd of sheep. So when all sheep start running for the exit, they're going to be running out of the same stocks that they have been buying in the last 4 months. And that's where you come in and you take advantage of all these analysts on TV that have been telling you just 2 days ago to buy the damn dip. And you take your accounts, 3x, 4x, 10x. Okay, these are the 5 conditions you need to pay attention to that are actually met. Now, I've shown you 2 cases, guys, in the history. I've got 1 more case in the history that's coming up on the charts when we're going to take a look at the VIX conditions. So now we have 5 conditions that are met that actually telling you the market is indeed going to make this TRO, trend reversal opportunity, to play it on the short side. Okay, so if you don't know, guys, how to trade and profit from stocks dropping, okay, again, there's a link under this video. Click it. Get more information. Okay, so the conditions, the 5 conditions that I'm at right now. And the most important one is right here. 13 markets move formula points to a big drop. Okay, virus is spreading fast. Okay, it's not how deadly the virus is. It's the unknown factor of the virus, okay, that gets everybody freezing up and panicking. Okay, now the second point is the time to do it is right now, because World Health Organization is quite far from their timeline that would be equivalent of the announcement that was done on March 12, 2013. That would actually be the time to actually start buying calls in the market, not puts, but actually the human mind is structured in such a way, even if you've been trading for a while, that the lower the market is going to drop, the more you're going to be enticed to buy the puts. But you got to do it while the market is actually at the top, because oftentimes by the time you finally keep watching the market drop and drop and drop and drop every day, by the time you decide to pull the trigger, guess what? the market starts going higher. It's reversing to the upside. So now, for the very first time, out of the last two instances that I've shown you, the first drop of 15% were due to the fears, uncertainty, and the unknown factor of what the SARS virus was going to bring in 2003. 15% drop. The second drop I've shown you in January 29th, 2 weeks after January 29th in 2018, was due to the fears of inflation. For the very first time in history, we actually have both of these situations. We got a virus that's spreading fast, that matches the timeline that tells us there's still a bigger drop that's about to happen. We've got the fears of inflation. Ray Dalio going publicly on TV in his interview recently saying, hey, inflation could be getting wild. It could be getting out of control here. Okay? We got 13 markets move formula. And finally, a great part of the formula is observing the VIX conditions and knowing how to read them. And I'm going to give you some historic examples that point that this absolute breakout in the VIX is about to take place. So when you combine all these things, it gives you a very high probability trade, guys. So important, pay very close attention to this. You will not find this information anywhere else. VIX conditions, December 2002. This is the VIX condition before VIX breaks out on the virus fears. Okay, VIX trading at 25, okay, before the headline surface of the virus appear everywhere. This is what the VIX does. It jumps 41% in just days. So it goes from here, a level of 25, all the way to 36. Now notice this one important characteristic, okay, is in most instances in the VIX, it tends to rocket higher and then it surrenders the gains rather rapidly. So in other words, it have a huge spike and then it drops rather rapidly and loses the momentum. Well, in this case, in this virus situation, VIX goes higher, drops a little bit, goes back up, drops a little bit, goes back up. If you look over this course of 60 days, it never dropped below 30. So now it's also important to understand it was traded in the 20s, which when I was trying to help you understand the market conditions, that the market was already in a downward spiral and it didn't have as much room to drop as it does right now. Therefore, the VIX was not starting out at 11 or 14. VIX was already starting at a higher level, and it did not actually stop the VIX from climbing even higher and maintaining that level. You will hear a bunch of people on TV saying, oh, the fears are overblown, everything's going to be fine. Short the VIX, short the VIX. They're going to wake up the next morning and the VIX is going to be at 30, 40, possibly 50. Now you're thinking, Leonardo, come on, VIX at 50. It's like last time I looked at it, last week it was at 11. Guys, let me show you this. This stuff is 100% real, and if you trade it the right way, these are the kind of trading opportunities that this is a trader's dream. This is a day trader's dream because you get to play the market on both sides. So here it is. VIX breaks out to critical levels right now as it did in January 29th. Now, what are these critical levels, Leonardo? Just tell me, damn it, what they are. Here it is, guys. As you can see, VIX is trading sideways. In 2017, November, sideways, small little spikes to about 14, 15, and it gets shot down. Boom, goes sideways, sideways. Now, this right here coincides with a level of 11.72. I don't know what it is with this 11.72. Sometimes it's 11.82, guys. That's the number from where VIX, historically in low VIX conditions, all of a sudden just starts rocketing. I've posted a video, guys, predicting this upcoming crash in December. Of course, nobody wanted to listen to it, but, you know, a lot of people are going to go back now and review that video. So if you haven't seen it, go back and review that video talking about the crash in 2012. 2020, which we predicted was going to happen by March or April of 2020. Now, we also predicted this crash right here, which caused the VIX to rally 340% in 1 week, guys. Damn it, we're not talking about 2 years here, guys. That's a 1 week, 340% move in the VIX. And I'm not even using the 11.8 level to calculate that. 11.72, 11.82. I'm using actually the level of 14.5 to calculate that, because these two orange dots, they represent the level of 14.5. So from 14.5 to 50, that's a 340% rise in the VIX. Now, the reason I'm talking about this 14.5 level, because that's exactly where we closed on Friday on the VIX. Another important factor to know about the VIX, that at some point we were at 15.9. Now, understand this. The moment we broke the 15.9 in the VIX, in January, the moment we broke above 15.9, we flew all the way to 50 in 2 days. Guys, literally. Okay, within a couple of days, we were, do you remember? I mean, go look it up. Go look it up on your chart software. February 2nd, okay, for like February 5th, 6th, that week right there. Okay, that's when we had some wild moves. I remember one of the days, the market overnight was down 1,200 points. Guys, we've seen the market drop 600, 700, no big deal, right? But 1,200 points overnight, I mean, that's even bigger than what we had in August 2016 on the Chinese fears and the slowing down economy in China. The manufacturing was dropping like crazy. Boom. 1,000-point drop that morning. But this one was even bigger. Okay, that's why VIX shot up all the way to 50. 1,200-point drop overnight. Guys, it could be happening this coming week, January 27th for January 31st. Be ready. The only thing that could slow it down is possibly some really good news from, companies that are announcing earnings. But guys, after all said and done, okay, next 2 weeks could be substantial. We could see this 1,200-point drops coming up. So let's focus back on the VIX here. So VIX breaks out to critical levels just as it did on October, November, December 2018. Clearly, it should say 2018, guys. Okay, we nailed the crash in 2018. This is how the VIX looked, okay? So 210% rise in the VIX from what point? Okay, from when the VIX actually breaks 15.9. Okay, it goes straight up to above 30. If you take a measurement over 2 months, it actually breaks higher, 245%. Each time it breaks and stops at 15.9, it reverses and jumps higher. So 15.9 is your critical level on the VIX, out of which the history points to us that VIX has jumped exponentially higher to the magnitude of a couple of hundred to a few hundred%. Now, the importance of understanding this is applying to where we are on the VIX right now, okay? And this is a 10-day chart. A VIX right here at 11.75 before it does what? Before it breaks out. You see the chart I was showing you on the VIX where it was side trending for quite some time, and then it finally broke out. Look where we were on Friday, 15.98. That 15.9 level. Guys, just to make sure everybody's paying close attention, okay? 15.9, VIX goes in the matter of a couple of days to over 30. 15.9, VIX goes to over 36 in literally 3 weeks. If you go back to this chart, okay, 15.9 is right here. VIX goes to 50 in a matter of days. Okay, that's, and look how VIX was side trending here. So hopefully you see the picture, because you really got to understand this in order to understand how wild things can get right now. So VIX is on the verge of breaking out. Yes, it hit the 15.98. It retraced back to 14.56. But what you should understand, so it did a few times here. So this would be the 14.5 level. So it gets, this candle is very similar to what we had on Friday on the VIX. So basically VIX shoot to the moon. Like we were at the 12, right? 12.75. It shoots to like 15, just 15.9, 16.2 area here. Then it finishes lower. It finishes at about 14.3. Then the next day, it goes all over the place. First, it dips to 12, goes all the way to 17. Then it finally breaks out right here. Okay, guys, this is, we're playing with some very, very important numbers right now. I mean, this is huge. Okay, so look at this, 14.5, 14.5, 15.9. Once it's above 15.9, look what happens. Boom. So understand the importance of 11.72, 14.5, 15.9, because basically that's going to help you answer this question. How high can VIX actually go short term? Based on the historical numbers, right, we can easily see VIX next week, the week of January 27th, January 31st, we can see VIX above 20. So that would be the first stopping point. It's not completely out of the equation that VIX could actually hit 50. Okay, it just depends how quickly the market unwinds. If we get another 1,200 point drop overnight, over the course of the next 10 days, doesn't matter which day it's going to be, right? We could see VIX at 50. So the answer to this question, how high can VIX go? It could easily hit 20 because from where it's at right now, okay, 14.56. Look at this candle. Guys, let me just rewind this one more time. Look at this candle right here. Do you see this candle, how it shoots to pretty much what looks like 16 right here? Okay, and then it finishes at 14.56. This candle is identical. This candle is identical to this candle right here. And it's so important. I really want you to understand this. This candle is identical to this candle right here, okay, in October of 2018, right before the market started crashing once, crashing twice, and really crashes the third time, the biggest one where VIX shoots to 36. That's the kind of candle we're looking at right now based off the Friday close. Now, it doesn't mean that all of a sudden you're going to get a quick crash. You can very well, the market could gap down tomorrow like 500 points. And again, you're going to be sitting there wondering, fuck, why didn't I listen to Leonard? What the hell was I thinking? Okay, so using historic numbers again, VIX could go to 20, 21. It could easily go to 36. There is a possibility of VIX actually shooting up to 50 at some point over the course of the next 2 weeks. Now, the question then becomes, is give us the most important information, Leonardo, is how low can S&P drop if that actually takes place. So we have a target that we've calculated based on our 13 market moves formula, charts diversion. We've calculated that S&P 500 could drop to a level of 3,025. Now I'm using S&P 500 here because I've already broke down the levels on the Dow Jones chart, right? We've looked at the 10% drop, 15%, 5% drop on the Dow Jones. So this right here, overall, we're thinking that the market could easily drop 10%. So Dow Jones could drop 10%, should be about 2,900 point drop. S&P could drop 300 points from here, just under, maybe about 270, 275 points. Puts us at a level of exactly 3,025. Now notice this number is just slightly higher than the 3,002 level right here, which would be the orange line. Pretty much we're saying it's going to stop right before it hits that support level. So at that point, it could be wise to start looking at some calls. That should be the bottom right there, but we'll clearly reevaluate that as we proceed over the next couple of weeks. So how do we actually trade this move? Now, historically, I've already shown you the example of BKNG and how it reacts to situations like January 28, 29, 2018. So here's the list of stocks, guys. I'm just going to throw them out there at you. You can use our charts divergence process to identify which ones will represent the best trades to you. And if you want to do that, click the link below and get started. Now, travel stocks, BKNG, XPE, CCL, RSCL, Wynn Resorts, LVS, they're not travel stocks, but they're highly impacted by travel to Hong Kong. So Wynn Resorts and Las Vegas, they got some pretty large number of their profits coming from that area. Hong Kong, China, all the gamblers like to go and visit those places to gamble there. And of course, Marriott and Hilton, okay, that as the travel stocks get impacted, they represent a great opportunity on the short side as well. Now, recently, this is what we actually pointed to our 13 markets move daily analysis subscribers, guys. BKNG, that was the trade. So we predicted this gap down. It did take place. Then we said shorted on the bounce, and thank God it had a ton of opportunities for anybody that listened to the video we've posted last Monday to actually short the bounce. All you had to do was wait for the bounce, shorted. Actually, the last alert was seen on Friday. The stock gaps down like 20 bucks. Then it opens up and bounces about $17. So last time we actually pulled the trigger on it, the stock was right here at $19.97, and it finished the day at like $19.58, $19.61 area, right around there. So it's been an easy trade, guys. And based on the charts that I've shown you, that still, okay, is a huge opportunity. Just focus on shorting it at the bounce, because you don't want to be the trader that's shorting it on the lowest part of the day. Okay, if you wake up tomorrow, it's already down, you want to wait for a bounce, then that's going to be your entry position. You collect the profit when it drops, get back into the position on the bounce, towards the end of the day, keep the position overnight, because there is a great probability of a gap lower on any one of these days. Okay, so BKNG, basically, after we've identified this initial drop and suggested a short around here, it drops, creates multiple opportunities throughout the week, but there's still great opportunity for the stock to drop all the way at this point to about $1,850, possibly $1,825. So still great opportunity on the short side. Just make sure that you guys are shorting it on the bounces. And the second recommendation, short semiconductor stocks and big tech. Yes, you do want to short Apple. Guys, Apple is announcing earnings in a day or two, and we're probably going to post a separate video on that, but you want to short the hell out of that thing, especially if it pops right after earnings. If Apple pops high after earnings, you want to buy puts, because the probability of a huge reversal is highly, highly likely. Okay, so don't buy options ahead of earnings. We actually done a number of trades doing that. That was not the rule that we typically use, but the options were so affordable last earnings season that in some stocks it actually made sense to do that. Now, generally, you don't want to buy puts ahead of earnings, so the easiest thing you can do right now is wait till the companies announce earnings, catch the right moment, the right entry, and pull the trigger after the earnings. And for those of you that have taken our courses, we got a lengthy explanation why you want to do that, why you want to stick to that strategy. So guys, if you're curious why that is the ultimate strategy for trading your earnings season, then definitely click the link below and take action. Okay, and the last but not the least, guys, short energy stocks. If indeed the situation with the virus gets worse, which, you know, it represents a great trading opportunity, but I certainly don't wish for that to happen. But if it does, okay, you should know that energy stocks will always take a hit in circumstances like this. All of a sudden, the demand for oil-related product drops short term. So you could see there's a couple of tickers right here. These stocks would be a victim of this virus outbreak, and they will actually move lower as well. So with that said, guys, trade like a rock star this week. If you want to know more specifics about like what strike prices you may want to buy in some of these tickers that we just shown you, what are the key levels for exit and entries, guys, and how to use the 13 market move formula for trading weekly options, simply just take action, click the link below, and get started now. Let's roll.